Bom, agora a apresentação do Paul. O Paul, 36 anos atuando no mercado, também começou com 15 anos de idade, né, Paul? E é terceira geração que atua nesse mercado de real estate. A grande vantagem do Paul é que ele, por 20 anos, ele foi construtor, incorporador, antes de entrar no mercado de dívida. Criou a Parkview Financial em 2009 e lançou o fundo logo em seguida, de 4 bilhões de dólares de empréstimos que eles já fizeram. Não teve nenhuma perda. Qualquer problema que teve com o devedor, ele conseguiu reestruturar e recuperar 100% do capital. Então, nós temos uma parceria muito boa com o Paul. Tem um fundo de dívida que já muitos dos nossos clientes já investiram. Então, eu passo a palavra para o nosso colega Paul. Obrigado.
Thank you. Good morning, everyone. Thank you for coming out. The good news is they told us we each speak for 30 minutes. Pedro spoke for 58 minutes, so I only have to speak for 2 minutes. So it's going to be really fast and easy, and we'll get through it. My name's Paul Rahimian, Parkview Financial. I'll give you a really quick background on myself. Third-generation real estate developer, general contractor. My father and I used to build projects in Los Angeles for about 21 years. 2008, 2009, the market crashes and we decide that we want to get into the lending space. Nobody was lending, banks weren't lending, there weren't a lot of private lenders at the time. We understood construction, so we thought this is a good opportunity for us to get into the space and do construction financing. And that's how we started Parkview. So today here, I'm really not here to talk about Parkview much, more about real estate debt, about what we're seeing in the marketplace, what we're seeing in the US. So we have a couple slides here, and if I know how to use it, there we go. So Pedro did talk about a lot of this stuff, but I think it's important to talk about how it relates to what we do. You looked at the cycle from 2000 to 2022. That was a long period of time where rates were low, inflation was low, and a lot of things in real estate really were easy. And so a lot of people did really well, not because they knew what they were doing, but because rates were low, and it made life very easy. I think in 2022 we saw a pivotal change that a lot of people were not expecting. And one of the problems is after 20 years of low rates, everybody was assuming rates would be close to zero forever. And the Fed was forced to increase rates because of inflation, and they increased it very quickly. And what happened with that is the cost of borrowing went up, but also it affected real estate. So Pedro talked about it, and he did a great job explaining that as cap rates go up, that means real estate values come down. And cap rates is just the yield you're getting. You have no debt, you buy an asset, what's the yield you're getting? What are you expecting to get? As interest rates go up, you expect a higher return, so you expect a higher cap rate. And when you expect a higher cap rate, real estate values come down. And you can look at any headline, you turn on the news, constantly they're talking about commercial real estate is distressed in the USA. What do they mean by that? It's really a headline. So you really have to get into the details of it. If you're talking about an office tower in San Francisco, yeah, that's distress, and that's going to be a problem. But if you're talking about a multifamily asset, an apartment building in Miami or Orlando, that's actually doing really well. And rents are continuing to go up, and cap rates haven't spiked there because there's a demand for that. So you really have to distinguish between the different asset types and how that's affecting what you're looking at. The chart here talks about how inflation went up. We all know it. We know what the Fed did, so we don't need to get into that too much. The good news is that the Fed has said they are going to lower rates this year. Nobody knows when, nobody knows how much. There's conversation about the fact that it is an election year, so that is going to possibly impact when they're going to lower rates. If they don't lower rates by July, it's really not going to help the election. So there is a huge consensus right now. They're putting the probability at about 90% that they will drop rates by July. Of course, that can change. It's data dependent. If they believe inflation's not coming down, they won't drop rates. But the reality is now that they've indicated that rates will come down, and the proof is there that inflation is subsiding, that means that we will see lower rates, whether it's this year in the amount of 25, 50, 75 basis points or more, or next year where we're going to see the projected another 100 basis points. What we want to talk about here is there is opportunities when interest rates are high in the real estate debt market. And you have to focus on what those opportunities are. And Pedro talked about it, and you see it here on the graph. You see it here up there, multifamily. I love using these pointers. It's so much fun. It reminds me of when I was a kid in school and I could go on the chalkboard. So multifamily and BTR, what are we talking about? We're talking about multifamily, which is an apartment building. Not very common here in Brazil, extremely common in the USA. Most people live in an apartment, and where traditionally most people owned a house in the US, you're seeing them move away from that and rent apartments. And as mortgage rates were very low in the past cycle, and people locked in huge mortgages at very low rates, people are not selling their homes right now, because if they sell their homes, they lose those 2%, 3% interest rates. So people really need a place to live. They're looking at multifamily apartments. BTR is the other one, build to rent, which Pedro talked about too. Huge right now. Why? Because people still want to live in that home. They can't maybe afford a mortgage when mortgages are elevated, so they go and they rent a home. You see a huge amount in Phoenix, you see it in Florida, you see it in different markets, but it's really a market that is booming right now. The reason we have this graph here, over here, is that it reminds me of when we started Parkview. So when we started Parkview, this is where we were in the marketplace. The reason we came in is because the banks got out. And the banks said, we're not going to do construction loans anymore. The world's coming to an end. We're not going to do it. And that's where we came in at Parkview, and we said, hey, this is an opportunity. We understand construction. We understand real estate. Why don't we provide construction loans to developers? You're seeing the similar conversation now. We're nowhere close to 2008, and nobody's expecting a crash like we experienced in 2008. But the conversation with the banks, same conversation. They're not lending. They don't want to do construction loans. They're out of the market. I can't tell you how many times in the past year we've had people come to our office that work at banks and ask us for a job, because they know the writing's on the wall that if they're in the department that does construction loans, the banks aren't going to do it, probably won't do it for another 3 to 5 years. So there's our opportunity is, again, we can step in and close some great loans to some great borrowers that we probably couldn't do a year or two ago. So SOFR, everybody knows the story here. The reality is that interest rates were close to zero in January of 22. Everybody was happy. Everybody thought it was going to be there forever. Fed woke up and said, we got to raise rates, and they did it really quickly. And now you're seeing SOFR rates at 5.33. And that affects real estate, affects mortgages, and affects all kinds of transactions that are related to real estate. The good news is, though, and we'll see the graph in a minute, is that it is coming down. We've really hit that peak. Everybody knows it. There's no doubt anymore that we've hit that peak, and it's a matter of how quickly it'll come down, when it'll come down. So we talked about a lot of good things. We got to talk about the bad as well. So this is the bad part. There's commercial real estate debt, mostly banks, in the United States that have huge maturities coming up. They had north of $600 billion in 2023 mature, and a lot of them were extended because the banks didn't want to take back these properties. So they literally extended the loans. They made excuses. They said, hey, you know what? Why don't we give you a 12-month extension, a 2-year extension? Why don't you figure out a way to pay us some interest? Maybe we'll sweep your income, which means the bank will take all the income from the property, but that'll give the borrowers an opportunity to live another day. The bad news is a lot of that got extended, but now in 2024, we see this huge number. And you see this huge number, close to $700 billion of real estate that's maturing in 2024. It looks bad. The good news is that we can work through it throughout the year. So the way the real estate community is experiencing this is some of the banks will give them relief and give them time. And if you hold real estate long enough and your leverage point is not too high, you always make it through a cycle. The key is time. And I think right now in the economy in the US, what the banks are trying to do is work through this time. Doesn't mean it'll work for all borrowers or all sponsors. If you were floating debt, which means your interest rate goes up with SOFR, and you have a lot of leverage, you're not going to make it through this cycle. And you'll likely lose your property in 2024. And that's an opportunity. We're in the debt space, so we can't take advantage of that opportunity. But if you're in the equity space like Jay or other people, there's opportunity in 2024 where you'll be able to buy some deals at a discount because people can't hold on. But as rates come down, that opportunity is going to slowly end because rates are going to come down. There's a lot of money, opportunistic money, waiting to buy distressed assets. They're going to jump in 2024, and likely you're going to see a lot of those assets get sold. And if you're looking for an opportunity to buy a distressed asset, you can't wait till 2025. Because if you wait till 2025, those opportunities likely won't be there. Rates have come down, and now everybody's jumped back into the market. So even though I presented this as bad news, the reality is it depends on your risk appetite. I'm in the debt space. I'm not in the equity space, so I can't take advantage of this. But if you're in the equity space, there's something here where you can jump in and buy things at a discount. The story is not only the U.S. So the U.S. is the majority holder of maturing debt in 2024. But when you look at this graph, just so you get a perspective, you'll see that in Europe you have about 200 billion, Asia Pacific, obviously around the world. This is a phenomenon where a lot of people brought in debt in 2020, 21, 22, 23. Now they're maturing and they're trying to figure out how to exit. Everyone's talking about this. Where's the Fed funds rate going to be versus cap rates? Again, as cap rates go up, where you see in the black line here is cap rates. Traditionally 9. People in my office that are much younger can't believe that cap rates were at 9 one day. I remember those days. So when they look at cap rates right now, they go, oh, wow, it's so high. But really, it's not that high. Will it come down? Yes. It's probably at the high of this cycle, of this past 20 years. Historically, it's not that high. And when you see the Fed funds rate spike the way it did in the past 24 months, there's no way cap rates are not going to go up. Because if the Fed's funds rate is at 5%, I'm not going to buy a real estate asset at a 3% cap rate, meaning a 3% yield, because I can put my money in the bank and get 5%. So that's a natural correlation. What I think is interesting about this graph, and the reason I wanted to bring it up, is that it doesn't always move like this. And people think, oh, rates go up, cap rates go up, and rates come down and cap rates come down. But it's not. It is correlated, but as you can see, it can take a long time. And even when rates were at 0, cap rates still didn't come down to 0. You still had a spread. So it's important to note that the Fed funds rate will come down and cap rates will move, but it takes time. Real estate is a very slow evolving process, and you can't assume cap rates will come down immediately, real estate values will spike. It's a process, and like Pedro talked about it, if you look at the outlook and you say, hey, let's look at 2025, 26, 27, great opportunities if you get in now. Because if you buy now or you get into a deal now, then when cap rates do come down in 25, 26, 27, that's where you achieve your maximum returns. 10-year treasuries is another indicator that everybody likes to look at. Again, they correlate it with cap rates. The 10-year spiked over the past 6 months or so as everybody realized longer for higher. The Fed kept saying, hey, we're going to keep rates higher for longer, and nobody wanted to believe them. And everybody said, no, rates are coming down in 2023. Didn't happen. Now the Fed has said rates are coming down, and so the 10-year has come down a little. It's hovering around 4%, which again, historically is not high. It's actually a decent number. Do we think it's going to come down? Yes, because as the Fed funds rate comes down, you're going to see the 10-year drop. You're probably going to see the 10-year drop in the 3s and go lower. And one thing to note is, where is the Fed funds rate neutral rate? if you go back to this slide, the neutral rate has actually changed. So 20, 30 years ago, the Fed funds rate could have been a neutral rate of 5, 6, 7, 8%. Now the Fed funds rate, projected neutral rate is 3.25. That means even though right now they're at 5.25, they believe that the economy of the United States will perform at its best and its optimal level and avoid huge booms and busts if the Fed funds rate is 3.25. That means they're planning to drop it at least 200 basis points over the next 1, 2, 3 years to get to that neutral 3.25. But what does that mean for us in real estate? That means there's a spread here where if the Fed funds rate is at 3.25, people will buy assets that are yielding 4.75, 150 basis points higher than the Fed, 5. So you'll buy assets at a 4.75, 5% cap rate, which means real estate values are going to become very strong during the next cycle as the Fed fund lowers their rates. So this graph, really not a pretty one, but it's actually a good one. So I have to explain what it means. So the line that you see coming down, kind of like an L, that's the SOFR curve starting today. So if you looked at the SOFR curve 2 years ago, it spiked up to 5% and then it came down. And 2 years ago, people didn't believe it and they said, there's no way. SOFR's at 0, it's never going to get to 5%. Well, guess what? We're at 5%. But the good news is, this is the same curve that they projected 2 years ago, and they're projecting it now. And what they're saying is SOFR is going to come down, and it's going to hover around the 3, 3.25. Very similar to what I was just saying about the Fed funds rate, because they are correlated. And as the Fed drops their rates, SOFR will come down too. Why is that important? Because commercial real estate in the USA is generally tied to the SOFR rate. So as SOFR rates come down, your cost of capital comes down, and your values of real estate goes up. So this is actually a good place to be. It took us 2 years to get here, and it was difficult for a lot of people. But now we're at that peak, and this is where rates will come down. Again, we don't know how quickly or when, but we know that rates are going to come down, and the Fed has indicated it's going to come down. So as it comes down, SOFR will come down, real estate values will go up. The other thing to look at is are all these little dots, which almost looks like somebody put this here by mistake. Those dots are important because what they do is they talk to the Fed governors in the US, and they take a projection and they say, hey, just give us a guess. We know you don't know, but where do you think your Fed funds rate will be in the end of 24, early 25? And they said, in between 4 and 5. And they said, okay, great. Now tell us, where do you think you're going to be in the end of 25, early 26? And now it's between 3 to 4. And you'll see these dots are coming down, which means the Fed itself is projecting that they are going to be lowering rates for the next 3 years. Of course, it's impossible to speculate 3 years ahead. If a recession occurs in the US, you're going to see that drop happen quicker. If for whatever reason inflation spikes or there's a black swan, they'll pivot off this. But they're saying everything we know today, all things being equal, this is our projection. And that's great news, because that means as, again, the Fed funds rate comes down, SOFR comes down, real estate values go up. So if you're looking at opportunities, this is really that opportunity. It reminds me of when we started Parkview in 2009 and 2010. Nobody was lending. Everybody was kind of confused about what's happening in the marketplace. But you really have to look at the data. And if you look at the data over the next few years, you see the opportunity is now. And the opportunity is not 3 or 4 years from now. A little bit about ourselves, and then I'm going to wrap up. So the fund has been open for a little over 8 years. We've closed over $4 billion of construction financing throughout the United States. We lend all over the US, in California, Washington, Oregon on the West Coast, through Phoenix, Denver, through Texas, Chicago, New York, Miami, Orlando, Tampa, so all across the US. And we do that on purpose. We like to be diversified. We like to be across the nation and have different exposure. We have about $800 million of investor money, and we've averaged about 12% of returns. This is a little bit about our portfolio. So if you look at our portfolio, we've closed about 200 loans over the past few years, about $4 billion. Currently, we have about $1.8 billion in our portfolio. It says 49 loans, actually 48. We got paid off on Friday of last week on a loan. That's always good news at our office. They always say it's easy to close a loan. The good news is when you get paid back on a loan. So we actually have a little bell in our office. Every time we close a loan, we ring the bell once. When we get paid off, we ring the bell twice. So because that's really the good news. Anybody can close a loan. The key is getting paid off. We've gotten paid off on about 150 loans, about $2.2 billion, and we continue to push those payoffs. If you look at this this graph with the colors, it just shows you an indication of our asset type, right? 73% of our loans is in the multifamily space. That's by design. That's the way we created the fund. The idea was that when the market changes in the United States, multifamily is the most resilient asset type. You always need to live somewhere. If anything, if you're doing multifamily that's not a luxury unit in a luxury space, then it actually does really well during recessions because people need to live somewhere. They might downgrade, they might lose their job, but they're still going to go rent somewhere. So by design, we've always tried to focus a majority of our loans on multifamily. And I think that's one of the reasons we've had 0 losses to date and we've done really well is because, yeah, we're underwriting well and we're doing all that, but it's also asset specific. One other thing I'll tell you before I finish is the way we operate. So what I think is different for what we do, and we call it our secret sauce, but it's really not that secret because we talk about it, is we have a construction division within Parkview. So what does that mean? That means we have estimators, structural engineers, civil engineers, general contractors, architects as part of our team. They're employees. And they go visit every single site, every construction loan, every month. And the reason that's important is we're not using a third-party vendor. We're not using an outside firm that really doesn't care and sends a different guy every time. We're sending the same guy to the same site every month. They know the owner, they know the contractor, they know the electrician and the plumber. And I always joke, sometimes our guy shows up and the electrician and the plumber are not getting along and they're fighting and we realize, wow, this could be an issue. Or the framing guy comes and says, you know, you were here last week and I know you gave money to the owner, but I didn't get paid. And that's a red flag. You usually don't hear those kinds of stories when you use a third-party vendor. And that's why we do it internally, because we have the ability to evaluate what's really going on this project. Is it headed the right way or is it a problem? And it doesn't mean there's never problems. You just want to anticipate those problems so you can have the conversation like we do with some of our borrowers where we say, listen, we heard you didn't pay your guys last month, so we're not paying you this month. And we know that's going to cause you issues, but let's figure out what the problem is here. If you're short on funds, you have to raise money, you have to bring in an equity partner. Let's solve it now. Let's not keep building, and then we get almost to the finish line, and now we have a bigger problem. So I think that's one of the key components of what we do. Obviously, happy to discuss it more. This is a little bit about how do you avoid risk, especially during a market downturn where there's perceived stress in the marketplace. So one thing we'll do, we'll sit with our borrowers and say, look, you got an issue because you're short on money. You have cost overruns, or it took longer, or interest rates went up. Whatever the case is, you don't have enough money to finish this project. So let's talk about, do you need an extension? We'll give you an extension, but you got to bring in an equity partner, which means you're going to bring more money to the table, but the project is going to be fully capitalized. We know you're going to get to the finish line, and when you get to the finish line, we get paid back. You get your property, everybody's happy. So it's an important thing to have those conversations at the right time and sit down with the borrowers. Another thing we talk about is exit plans. Again, we as a lender, our number one goal is how do we get our money back? So we'll sit with our borrowers and say, listen, you guys are a little bit late on the schedule. We don't think you're going to hit it, but we want to make sure that you do. Your loan is about to mature, say in 3 months, but you know what? We'll make a deal with you. We're going to fund you for the next 6 months. So we're going to fund you past your maturity date. We want to make sure you can get to a point where you can take us out. But you got to promise us that in the next 6 months, you're going to go find another lender. And we want you to communicate with us. Who's that lender? When's the closing date? And we'll literally call the other lenders, because we know everyone in the space, and say, are you really going to do this loan? If you are, we'll continue to fund him for the next 6 months. We want to make sure we're going to get paid off. Rebalancing provisions, this basically goes to the issue of, do you need to rebalance the loan? Is it out of balance? Out of balance means a lot of things. They're late, they don't have enough interest money in their interest reserve, the loan's about to mature and they're not even close to being done. So there's a lot of provisions in our loan documents. It's important that you have to be cognizant of what they are. We don't always enforce them. Sometimes you have good borrowers, they're progressing, and you don't want to be difficult with them because you know they'll get it done. But you have to balance which ones are you going to be more difficult with and which ones you're not. And Pedro and I were talking before the conference, and he said, look, not all borrowers are great, and some of them are problems, and how do you decide what to do? And I told him, I go, there's no formula. So you're going to sit there and you're going to say, look, this borrower is a repeat borrower. He's gotten it done before. Let's give him 90 days to figure it out. And if he doesn't figure it out, maybe we have to do something else. But if he can figure it out, let's give him the benefit of the doubt. But this other borrower, this guy's a problem. And he has a balance sheet, but for whatever reason, he's not paying our interest. So let's file that notice of default and go after him and put pressure on him. So again, some of them you put pressure on, some of them you don't. It's a case by case. And that's all I got. Thank you so much. Thank you.